Hi there, it's Mark Carosa, Regional Director of Multi-Funds, and welcome to the First Time Seller Series. This is a 10-lesson series presented by Mazan Partners. Now, each of these lessons can be watched on YouTube under the search Mazan Partners First Time Seller Series. Today, I'm joined by Casey Corey, founder and president of Mazan Partners, and we're going to dig into lesson number 9, deal term negotiations. Now, before we get started, please share this video with your colleagues. Maybe they're considering selling their practice and this video is just what they need to hear. Okay, let's get to it. So Casey, I'm excited to dig into today's topic, but before we do, please tell us a little bit about Mazan Partners and why you decided to create the First Time Seller Series.
Thank you, Mark. Mazan Partners is a 25-year-old consulting firm. We focus on mergers, acquisitions, and succession planning, specifically for the advisory arena. The primary reason that that we started to do this series was that we know that sellers are at a little bit of a disadvantage. Buyers, can buy many times over. They get a little bit better at it every single time. I know we learn every time we do one, and we've been doing them for a long time. And sellers generally sell once, and you need to get it right the first time. So we thought maybe that this series would help level the playing field a little bit for some of the sellers that are out there, potential sellers.
Right. Okay. So Casey, one of the questions we get most often is, what are the typical or most common deal terms? Now, I know the short answer is it depends. What does it depend upon?
It depends on what the seller's desires are post-sale. Do you want to sell and walk away immediately, which means that all the risk goes to the buyer in that case? Are you willing to stay on for, say, 6 months to a year and help transition the book? Keep in mind that doesn't mean that you're going to come into work every day. It just means that you're available for preset appointments to introduce the buyer. The buyer to your clients. Do you want to continue working after the sale? What does that look like for you? Do you want to join a firm with the idea that you'll sell in 2 or 3 years? That's another way to go about it. These are just a few possibilities. Each one has its effect on the terms of the deal. Price sometimes dictates terms, but terms also can dictate the price. And frankly, it's more the latter than the former generally. For example, if you want to sell and walk away immediately, without helping with the transition, you get less for the book. You're gonna lesser price because in some cases the buyer won't even buy. It's simply too risky unless the buyer discounts the book as much as 70% to make that term, and that's really not good for anyone, least of all the seller. By the way, any buyer that is trying to finance one of these acquisitions, through a bank or a private equity firm or something like that, with that term, with the buyer walking away immediately, we'll find it next to impossible to finance the deal. You won't find a bank that will agree to that. And if you do find it, what the bank will do is they'll ask the seller to carry a substantial part of the loan in order to incentivize them to sell, to transition the book. If you're willing to stay on for some period of time and help with the transition, then you'll find a buyer much more willing to pay a better price and even come up with a healthy down payment. Depending on your relationship with the clients, i.e. how often you talk to them, or you see them, having you help with that transition is extremely beneficial to a buyer and the buyers will see that as their risk being substantially, reduced. It is not uncommon to see down payments in the 30 to 50% range. In some circumstances, we even see them in the 60 to 70% range for a down payment, with the remainder held back to cover the book in loss, or some of the loss in the book. We'll talk about that in a minute, I'm sure. A typical term might be 30 to 50% down, and the rest in 2 to 3 payments over 2 to 3 years, sometimes 5 years. It just depends. The last 3 we've done have been 50% down, 25% in 6 months, and 25% at the end of the close, a year from the close, with a provision to mitigate loss of assets incorporated into the second or the third payment.
I see. So let me ask you this. So how do the provisions to mitigate loss look?
So some people call that a clawback. Technically, a clawback refers to the situation where the seller is asked to return money that they've already received. We're not big fans of that, so we favor a mitigation provision rather than a clawback. Let's say the sale price is $1 million and the buyer finances that sale through, let's say, an SBA loan. Further, let's say that the terms are, as I said earlier, 50% at closing and the remainder in 2 payments, 25% in 6 months, 25% a year from the closing. So the $500,000 at closing, $250,000 in 6 months, and $250,000 at the end of a year. After the initial $500,000 payment, the rest of it goes into escrow, and it's held by an escrow agent, and then it will be distributed by that agent according to the terms of the agreement, the contract. For simplicity's sake, let's say the mitigation provision has been assigned to the final payment, that last 25%. It might say something like, there will be a potential reduction in this final payment if the total assets as calculated at the close are 90% or less than 90% of the total assets at the time of the close. If the assets are less than 90% of those at the close, due to redemptions or clients leaving or not moving over, then the percentage below 90% will be multiplied times 250, the last payment, and then subtracted from the $250,000 payment. So what is it? Here's an example. And all assets are $50 million. All the assets at the close are 50 million. All the assets at the end of 1 year are 40 million. So there's a 20% reduction in the assets there. So you would take 10%, because it's only the part over 90. So you would take 10% and multiply times 250 or $25,000, subtract that from the 250, and your total payout on that last payment is going to be $225,000, and that would be issued, a check would be issued by the escrow agent. As I said, you get sort of a free ride on the first 10%, so that would not reduce it, but the next 20 or the next 10% would. In most cases, there's also a required interest rate applied to the unpaid balance on the installment loan. That's true in most states. Usually it's around 2 to 4%. It sort of averages around 2.5 to 3. This is typically included in that last payment as well, so it would be added to the final payment. Once the calculation is complete, the escrow agent obviously issues the final funds. This is just an example, but generally the mitigation provisions are levied against funds at the end of year 1 or 2. The concept is that the seller has some participation in moving the book, in the transition, and he or she will have some influence on that happening, and that the assets move over, when the assets move over in those first couple of years. After that second year, generally the onus is on the buyer to hold on to those assets, in the future. Most of these loans are 10%, or 10 years. So the buyer obviously wants to be able to hold on to it at least that long. But that originally it's it's those first 2 years that matter.
So Casey, are market fluctuations subject to those provisions?
They can be. The truth is almost anything can be negotiated and inserted into a sale agreement. Where I've seen this most often is when a seller received a sale price but plans to work for the foreseeable future, not 2 or 3 years, but for a while. And funds could be subject to some kind of performance then. For the seller who plans to help with the transition and then move on to the next phase of their life, we don't see, provisions for market swings. Clients that don't move over or, don't stay at least a year or I guess die, all those could be in part of a provision, but usually market swings are exempted. There's not much a seller can do about those.
Well, can you talk about consulting agreements for sellers who want to sell but continue working for a few years?
Sure. I'm going to talk about the seller who really wants to step back from the grind, but wants to keep his or her hand in on some level for some number of years. This is different from the 40-year-old guy or woman who wants to sell, but join a larger firm and keep working as an employee. We'll discuss, or in effect, the advisor is trading ownership responsibilities for advisor responsibilities there. So ownership, compliance and other things that owners have to worry about, those are being passed or delegated to the larger firm. We'll discuss that in a future webinar. I'm happy to discuss it with someone. If they want to contact me, we'll have contact information at the end of this. Many, if not all, or many, if not most sellers that we work with would like to continue to keep their hand in, but probably on a reduced time commitment. They know that they will continue to get referrals in their market area and would like to bring some of those to the buyer of their book. They also, on occasion, want to keep a few clients of their own, maybe a few that they'd like to keep servicing, or at least, be kind of an ambassador, or we call it chairman emeritus sometimes, for the new firm. Some are invited to sit on investment councils, investment committees, kind of like what law firms call of counsel, for example. We're doing one right now down in Texas, in which we have invited the former owner to join the investment committee for the firm that he just sold. Most buyers see nothing but positives to this arrangement, as long as a few ground rules are considered or set. The biggest one, the one that's most obvious, is that it's not in anyone's interest for clients to become confused. If the seller doesn't think that the buyer is going to be good for their clients, or that they can trust their clients with that buyer, they shouldn't sell to them. They should walk away. It's like I said, it's not in anyone's interest to make those clients wonder about the new advisor. It's not the buyers, not the sellers, and certainly not the client's interest. It's obviously important that the new clients know that that the old advisor has trust in the new owner, And that's good for the buyer, obviously. It is not in the seller's interest because, as we've been discussing earlier, there are times when some of his or her future payments are such that, you know, it's important for them to keep moving the book over, have the book stay. So it's not a good idea for them because it could diminish some of their payments in the future.
Mhm.
And most of all, the clients aren't served, you know, because if they don't know who to believe. So it's critically important that if an old client were to ask the seller, whether he would, you know, whether he would do what the new advisor said, that he or she tells that older client, you know, I'm deferring to them. You really need to do that too. You just don't want to put them in the middle. If a seller says, you know, to one of their older clients, you know, I wouldn't do it that way, or I wouldn't do it the way he's doing it. Well, you know, now the client has no idea what to do. And generally what will happen is that they will go to a third advisor, someone not part of this agreement, and they seek them out because they don't want to get between the buyer and the seller. With that said, any buyer who makes significant changes in the portfolios of the clients without ample time to get to know them well enough, they're playing with fire. This is a primary reason why we think it's very important to seek out a buyer who, at least in principle, agrees with the way that you manage money, manage portfolios. It's just plain stupid for a new buyer to go to a client and say, hey, remember what Casey did, you know, for the last 20 years or told you for the last 20 years? Well, he's wrong and I'm right.
Oh,
You know,
yeah.
clients will be gone in a heartbeat if you do that.
Yeah.
A buyer who does not understand that is probably not a good buyer for your book or your clients. So you want to avoid that like the plague if you can. As I said, most buyers welcome a seller sticking around for some period of time. So we often create consulting agreements that compensate the former owners for referrals or even for service work beyond the transition. Assistance with transitioning the book is sort of baked into the price. It's typically worked into the sale price as risk mitigation, which increases the price offered. But work beyond the transition can and often does carry compensation, usually in the form of an hourly fee or something for service work, and for referrals, usually it's expressed in the form of a revenue share for some period of time. It could be just the first year only, or it could be for, you know, a long time period. We did one here recently where the seller who has a consulting agreement will have if he brings a referral and they bring him on, he will get paid for 5 years on that one, and or for as long as he's around, but a minimum of 5 years, meaning that if he was to die, let's say in year 3, his spouse would get, you know, another 2 years worth of comp on that account.
So finally, Casey, how about tax treatment on the proceeds?
We usually try to get as much of it in capital gains as we can. We're buying goodwill in a client list, both of which in most states qualify for capital gains. I have seen part of a sale price in the form of a 1-year consulting agreement so that the buyer can deduct it as an expense, and then the rest of the proceeds came to the seller with capital gains. So we did one recently where 25% of the purchase price is to be paid in monthly installments in the form of a 1-year consulting agreement between the buyer and the named seller, and to assist with the transition. In this example, though, the seller received capital gains on 75% of the sale price, and the buyer was able to deduct the 25% as compensation in that first year, lowering his cost of capital. We did raise the overall price to account for some of the taxes that the seller would pay, on the extra money. The discussion of terms can go on and on, as we both know. But one thing I want to leave you with is this advice. Some LOIs, letters of intent or offer letters, will only talk about the sale price, and then they'll be kind of nebulous about what the terms are going to be. As a seller, you want to get as much clarity as possible in that letter of intent so that you can begin to do your own cash flow planning and tax planning. So you can talk about terms till you're blue in the face, but you want to make sure that you get it in writing so you got something to respond to that you can take to your attorney, your accountant, and so forth. But the sooner you know about those things, the sooner you can plan. So I would hold out for clarity in the letter of intent or the LOI when you're selling to someone.
Well, Casey, I've really enjoyed our time today, and this has been another insightful lesson. And I hope we've given financial advisors that are considering selling their practice some powerful insight. Now, next time, lesson number 10, a case study. Please send your confidential questions to mark.carrozza@multi-funds.com or ccorey@mazonpartners.com. And until next time, here's wishing you and your clients health and prosperity.
Thanks, Mark.
Thank you, Casey.